Welcome to the monthly market commentary. At the Reliance Expert series today, we have with us Mr. Manish Gunwani, CIO Equity Investments, to share his views for the Indian equity market. Welcome, sir. So, we've just recently witnessed the state election results for the major states that we've had. The equity markets have, remained, despite the expectations that we had, and, we've witnessed a very contrary results to it. So, they've stayed quite strong. So, what do you think are the positives that the market was holding on?
Yeah, along with the state elections, we had the resignation of the RBI governor.
Of course, how can we miss on that?
And to that extent, it's been a bit surprising about the strength of the markets. But I think what my experience has been that the fall in crude price, obviously a very, very big positive for Indian macro.
Factor, absolutely.
And that when the prices of oil fall, what I've typically seen is the stock market doesn't react to that instantaneously, because while the price of oil is falling, there is a fear that it is very deflationary, that is the globe going into a recession, is there a crisis coming? But when the crude price stabilizes and then people realize that all is pretty okay with the world, and now that India's current account deficit and inflation outlook is much better. So one is that the market typically then becomes healthier once the fall is arrested.
Absolutely.
So if you see now that crude has stabilized around 60, people I think are more comfortable, because while India's macro has improved, it's not that the world is going into a recession or anything of that sort. So that is one angle to it. I think the second positive, as I see it, which is a bit related, is the inflation data is coming out, and that's clearly reflected in the yield. So we've seen the 10-year yield come from 8.2 to 7.4 roughly. Now that is obviously a very big benefit to financial sector. Finally, it will get passed on to the consumers. So these positives, I think, is what is holding the market at current levels. Finally, I think there is also some expectation of easier fiscal and monetary policy, but we'll have to see it how that goes.
We'll have to wait for the relaxation.
Yeah.
So you brought in the point of globe actually. So my next question is very much related to it. That the global outlook looks quite hazy, especially growth concerns over Europe and China. Also, US is displaying a slowdown signs as well. So how would you if you have to throw some outlook on the same?
Actually, I think the US slowing down is actually positive for India to my mind.
I agree.
Because what we've seen is generally when US is doing very well, the US bond yields go up and US dollar strengthens.
And the currency.
In that situation, emerging markets like India don't do well. So I think if US slows down without going into a recession, that's the best possible outcome for India.
For India.
So in a sense, I'm not so worried about US. Europe and China, obviously, I think their growth rates matter, especially China, because obviously now it's a very big economy.
Yes.
And there's a lot of implications about commodity prices based on China's growth. But at this point, it does not look like there's a catastrophe out there. It just looks like they're slowing down. And overall, things are building up quite nicely for India, to my mind, that you want the world to do okay, but not too great as
Absolutely.
well. And we're kind of building to that situation as of now. So from the data we can see right now, neither is the world going into a recession, and neither is it accelerating in growth. So that, I think, plays well to India's strengths.
We're at the ignition point, I guess.
Right.
No one's moving very well. So, we recently viewed that, mid caps have, the data shows that there was a sharp underperformance in the last few months compared to large caps, and majorly because of valuations and macros. When we see there's a lot of improvement in these factors, do you think at this juncture we should be evaluating the sector?
Definitely, I think clearly with the correction in absolute terms we've seen since January, and the fact that 1 year is gone, so you're looking at an earnings 1 year later.
Yes.
Definitely from a risk reward perspective, I think there's been a big improvement. Now, we have to see it in context that, of course, from 2014 to 17, mid caps did very well. So I think 2018 was a kind of catch up of large caps versus mid caps. To my mind, it's largely done also because even within mid cap, first of all, it tends to be a very vast space, so you can always find something which is appealing. But in a more general sense, what we've seen is while the mid cap index did very well over the last 4 5 years, a lot of it was driven by consumer facing names, whether it's consumer staples, consumer discretionary, or retail oriented financial names.
Got it.
A lot of other sectors like real estate, cement, utilities, they did not participate in the mid cap boom on a sustainable basis. So now I think a lot of those segments are reasonably attractive, and there are a lot of names within that. So we definitely think that we can't call mid cap expensive on an aggregate basis now, given the correction that has happened. There are segments, as I said, typically asset heavy segments, utilities, hospitals, hotels, cement, real estate, and some NBFCs which have corrected post this liquidity issue. I think there are a lot of NBFCs which serve a niche in the economy which banks can't reach out to. So whether it is gold finance or real estate financing, and I think a lot of the good NBFCs also have corrected. So on an overall basis, there is a lot of decent value in mid caps at this point of time.
We can look forward to it.
Yes.
So that takes care of my mid and small cap. You know, when we talk about the Reliance Growth Fund, the mid cap oriented strategy that we run with a large track record, a very well established track record. So what are the key positionings and the themes that you're overweight on?
So since we're seeing some kind of softness in global economy and India's macro has improved, on an overall basis, we are overweight domestic businesses versus global businesses. We are overweight financials because clearly when a country's macro does well, financials benefit because interest rates are coming down, growth is picking up, etc. So within financials, generally we have overweight on private banks because given the liquidity tightness in NBFCs, we are seeing a lot of market share shift to banks. Second is very niche NBFCs in gold finance, etc. We are overweight that as well. Outside financials, as I mentioned, a lot of asset heavy industries, they are pretty cheap. So we have overweights in cement, real estate, hospitals, etc.
Sure.
So I think it's a mix of growth and value strategies, but incrementally the value part of the portfolio is increasing.
Sure. So at this juncture, you know, we've got everything happening around. There are elections, there are general elections, macros improving, trade warriors, and everything is, you know, going in the right track. So what is your advice to the advisors and the, you know, investors? How should they look, you know, forward to building up their portfolios?
So earlier this year, we were saying that large cap is preferable to mid cap, but as I mentioned, now that mid caps have corrected both in price terms and time terms, I think we are largely neutralish between large and mid caps. So the ideal strategy is actually the multi caps, but broadly more than market cap, I think it's time to notch up equity allocations a bit because markets have corrected a bit, valuations are looking attractive with oil going down and some other commodities also correcting. I think the outlook on inflation is very positive for capital markets. My feeling is interest rates have a downward bias. So given this landscape, I think it's a good time to allocate money to equities and notch up the risk level a bit.
Sure. You know, this takes care of my domestic advisors and investors. When I talk about my global investors, the currency is a big impact that comes into picture. So would you like to throw some light on the same?
Yeah, so if you see what is happening now is US growth is a bit of an enigma at this point of time. You're definitely seeing some signs of US growth disappointing, and the dollar's done very well for last 5-6 years. So whether it is dollar versus emerging market currency index or dollar versus rupee,
Mm-hmm.
my sense is that the best part of dollar bull run is over. And given that India is an oil importer, which obviously benefits from oil going down,
Mm.
unlike some of the emerging market countries which are commodity dependent,
Absolutely.
I think the Indian currency has a good chance of outperforming other
The
emerging
other
market
hands.
currencies. And since the emerging market currencies themselves look favorable versus the dollar, um, I think Indian currency will largely be stable with slight appreciating bias in the near term, to my mind. So that also sets up a good landscape
Right
for
landscape.
foreign investors because their return is a stock market return plus currency.
Currency
And
impact,
if currency
absolutely.
remains stable, that's a big positive for them.
In fact, that's very insightful, sir. Thank you very much for joining us, and it's always a pleasure to have you with us. Thank
Thank you.
you. Investors may please ask us their questions or email it to us or follow us on Twitter. The details are right on the screen. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.